Zero is saying Chapter 7 portfolio policy for the enterprising investor, the positive side. The enterprising investor, by definition, will devote a fair amount of his attention and efforts toward obtaining a better than run-off-the-mill investment result. In our discussion of general investment policy, we have made some suggestions regarding bond investments that are addressed chiefly to the enterprising investor. He might be interested in special opportunities of the following kinds. Tax-free new housing authority bonds effectively guaranteed by the United States government. 2. Taxable but high-yielding new community bonds, also GUAR, guaranteed by the United States government. Tax-free tax-free bonds issued by municipalities, but, viced by lease payments made by strong corporations. References have been made to these unusual types of bond issues in Chapter 4. At the other end of the spectrum, there may be lower quality bonds obtainable at such low prices as to constitute true bargain opportunities. But these would belong in the special situation area where no true distinction exists between bonds and common stocks.t operations in common stocks. The activities specially characteristic of the enterprising investor in the common stock field may be classified under 4 heads. 1. Buying in low markets and selling in high markets 2%. Buying carefully chosen growth stocks 3. Buying bargain issues of various types 4. Buying into special situations. General market policy, formula timing. We reserve for the next chapter our discussion of the possibilities and limitations of a policy of entering the market when it is depressed and selling out in the advanced stages of a boom. For many years in the past, this bright idea appeared both simple and feasible, at least from first inspection of a market chart covering its periodic fluctuations. We have already admitted ruefully that the market's action in the past 20 years has not lent itself to operations of this sort on any mathematical basis. The fluctuations that have taken place, while not inconsiderable in extent, would have required a special talent or feel for trading to take advantage of them. This is something quite different from the intelligence which we are assuming in our readers, and we must exclude operations based on such skill from our terms of reference. The 50-50 plan, which we propose to the defensive investor and described on P90, is about the best specific or automatic. 4. Moolah we can recommend to all investors under the conditions of 1972, but we have retained a broad leeway between the 25% meaning ago MUM and the 75% maximum in common stocks, which we allow to those investors who have strong convictions about either the danger or the attractiveness of the general market level. Some 20 years. It was possible to discuss in great detail a number of clear-cut formulas for varying the percentage held in common stocks with confidence that these plans had practical utility. The time seemed to have passed such approaches by, and there would be little point in trying to determine new levels for buying and selling out of the market patterns since 1949. That is too short a period to furnish any reliable guide to the future. Growth stock approach. Every investor would like to select the stocks of companies that will do better than the average over a period of years. A growth stock may be defined as one that has done this in the past and is expected to do so in the future. Thus, it seems only logical that the intelligent investor should concentrate upon the selection of growth stocks. Actually, matters more complicated, as we shall try to show. It is a mere statistical chore to identify companies that have out 50 or 100 such enterprises from his broker.t. Why then should he perform the averages in the past? The investor can obtain a list of group and low. He has a guaranteed successful stock portfolio. Not merely pick out the 15 or 20 most likely looking issues of this. There are 2 catches to this simple idea. The first is that common stocks with good records and apparently good prospects sell at correspondingly high prices. The investor may be right in his judgment of their prospects and still not fare particularly well, merely because he has paid in full and perhaps overpaid for the expected prosperity. The second is that his judgment as to the future may prove wrong. Unusually rapid growth cannot keep up forever when a company has already registered a brilliant expansion. Its very increase in size makes a repetition of its achievement more difficult. At some point, the growth curve flattens out, and in many cases it turns downward. It is obvious that if one confines himself to a few chosen instances, based on hindsight, he could demonstrate that fortunes can readily be either made or lost in the growth stock field. How can one judge fairly of the overall results obtainable here? We think that reasonably sound conclusions can be drawn from a study of the results achieved by the investment funds specializing in the growth stock approach. The authoritative manual entitled Investment Companies, published annually by Arthur Wiesenberger Andap Company, members of the New York Stock Exchange, computes the annual performance of some 120 such growth funds over a period of years. Of these, 45 have records covering 10 years. Average overall gain for these companies, unweighted for size of fund, works out at 108% for the decade 1961 to 1970, compared with 105% for the S&P Composite and 83% for DJIA. In the 2 years 1969 and 1970, the majority of the 126 growth funds did worse than either index. Similar results were: standing rewards came from diversified investment in growth companies as compared with that in common stocks generally. More, the, or. WW. There is no reason at all for thinking that the average intelligent investor, even with much devoted effort, can derive better results over the years from the purchase of growth stocks than the investment companies specializing in this area. Surely these organizations have more brains and better research facilities at their usual type of growth stock commitment for the enterprising disposal than you do. Consequently, we should advise against the investor. This is one in which the excellent prospects are fully recognized in the market and already reflected in a current price. Earnings ratio of, say, higher than 20 for the defensive investor. Earnings of past 7 years. The two criteria would be about: we suggested an upper limit of purchase price at 25 times average, equivalent in most cases. Stock the high. www.lo.org. The striking thing about growth stocks as a class is their tendency toward wide swings in market price. This is true of the largest and longest established companies, such as General Electric and International Business Machines, and even more so of newer and smaller successful companies. They illustrate our thesis that the main characteristic of the stock market since 1949 has been the injection of a highly speculative element into the shares of companies which have scored the most brilliant successes and which themselves would be entitled to a high investment rating. Their credit standing is of the best, and they pay the lowest interest rates on their borrowings. The investment caliber of such a company may not change over a long span of years, but the risk characteristics of its stock will depend on what happens to it in the stock market. The more enthusiastic the public grows about it, and the faster its advance as compared with the actual growth in its earnings, riskier a proposition it becomes. But is it not true, the reader may ask, that the really big fortunes from common stocks have been garnered by those who made a substantial commitment in the early years of a company in whose future they had great confidence and who held their original shares unwaveringly while they increased 100% fold or more in value? The answer is yes, but the big fortunes from single company investments are almost always realized by persons who www.lo.org. have a close relationship with the particular company through employment, family connection, etc., which justifies them in placing a large part of their resources in one medium and holding on to this commitment through all vicissitudes, despite numerous temptations to sell out at apparently high prices along the way. An investor without such close personal contact will constantly be faced with the question of whether too large a portion of his funds are in this one medium. Each decline, however temporary it proves in the sequel, will accentuate his problem, and internal and external pressures are likely to force him to take what seems to be a goodly profit, but one far less than the ultimate bonanza. 3 recommended fields for enterprising investment to obtain better than average investment results over a long pull requires a policy of selection or operation possessing a twofold merit. 1, it must meet objective or rational tests of underlying soundness, and 2, it must be different from the policy followed by most investors or speculators. Our experience and study leads us to recommend 3 investment approaches that meet these criteria. They differ rather widely from one another, and each may require a different type of knowledge and temperament on the part of those who essay it. They're relatively unpopular. Large company, I have to assume that it is the habit of the market to overvalue glamorous. For some other reason, it is logical to expect that it will mon stocks which have been showing excellent growth or are undervalue. Relatively, at least companies that are out of favor because of unsatisfactory developments of a temporary nature. This may be set down as a fundamental law of the stock market, and it suggests an investment approach that should prove both conservative and promising. The key requirement here is that the enterprising investor concentrate on the larger companies that are going through a period of unpopularity, while small companies may also be undervalued for similar reasons, and in many cases may later increase their earnings and share price. They entail the risk of a definitive loss of profitability and also a protracted neglect by the market in spite of better earnings. The large companies thus have a double advantage over the others. First, they have the resources and capital and brainpower to carry them through adversity and back to a satisfactory earnings base. Second, the market is likely to respond with reasonable speed to any improvement. Shown. A remarkable demonstration of the soundness of this thesis is found in studies of the price behavior of the unpopular issues in the Dow Jones Industrial Average. In these, it was assumed that an investment was made each year in either the 6 or the 10 issues in the DJIA, which were selling at the lowest multipliers of their current or previous year's earnings. These could be called the cheapest stocks in the list, and their cheapness was evidently the reflection of relative unpopularity with investors or traders. It was assumed further that these purchases were sold out at the end of holding periods ranging from 1 to 5 years. The results are these. Investments were then compared with the results shown in either the Dow as a whole or in the highest multiplier, i.e. the most popular group. The detailed material we have available covers the results of annual purchases assumed in each of the past 53 years. In the early period 1917 to 1933, this approach proved unprofitable, but since that method has shown highly successful results. In 34 tests made by Drexel and Company, now Drexel Firestone, of 1 year, holding from 1937 through 1969, the cheap stocks did definitely worse than the DJIA in only 3 instances. The results were about the same in 6 cases, and the cheap stocks clearly outperformed the average in 25 years. The consistently better performance off low multiplier stocks is shown table 7-2 by the average results for successive 5-year periods when compared with those of DJIA and of the 10 high multipliers. The Drexel computation shows further that an original investment of $10,000 million stayed in the low multiplier issues in 1936 and switched each year in accordance with the principle would have grown to $66,900 by 1962. The same operations in high multiplier stocks would have ended with a value of only $25,300, while an operation in all 30 stocks would have increased the original fund to $44,000. The concept of buying unpopular large companies and its execution on a group basis, as described above, are both quite simple. But in considering individual companies, a special factor of opposite import must sometimes to be taken into account. Companies that are inherently speculative because of widely varying earnings tend to sell both at a relatively high price and at a relatively low multiplier in their good years, and conversely at low prices and high multipliers in their bad years. These relationships are illustrated in Table 7-3 covering fluctuations of Chrysler Corp. Common. In these cases, the market has sufficient skepticism as to the continuation of the unusually high profits to value them conservatively, and conversely when earnings are low or non-existent. Note that, by the arithmetic, if a company earns next to nothing, its shares must sell at a high multiplier of these minuscule profits. As it happens, Chrysler has been quite exceptional in the DJIA list of leading companies, and hence it did not greatly affect the low multiplier calculations. It would be quite easy to avoid inclusion of such anomalous issues in a low multiplier list by requiring also that the price be low in relation to past average earnings or by some similar test. While writing this revision, we tested the results of the DJIA low multiplier method applied to a group assumed to be bought at $4,000. The end of 1968 and revalued on June 30th, 1971. This time, the figures proved quite disappointing, showing a sharp loss for the low multiplier 6 or 10 and a good profit for the high multiplier selections. This one bad instance should not vitiate conclusions based on 30-odd experiments, but its recent happening gives it a special adverse weight. Perhaps the aggressive investor should start with the low multiplier idea, but add other quantitative and qualitative requirements thereto in making up his portfolio. Purchase of bargain issues. We define a bargain issue as one which, on the basis of facts established by analysis, appears to be worth considerably more than it is selling for. The genus includes bonds and preferred stocks, selling well under par as well as common stocks. To be as concrete as possible, let us suggest that an issue is not a true bargain unless the indicated value is at least 50% more than the price. What kind of facts would warrant the conclusion that so great a discrepancy exists? How do bargains come into existence, and how does the investor profit from them? There are two tests by which a bargain common stock is detected. The first is by the method of appraisal. This relies largely on estimating future earnings and then multiplying these by a factor appropriate to the particular issue. If the resultant value is sufficiently above the market price, and if the investor has confidence in the technique employed, he can tag the stock as a bargain. The second test is the value of the business to a private owner. This value also is often determined chiefly by expected future earnings, in which case the result may be identical with the first. But in the second test, more attention is likely to be paid to the realizable value of the assets, with particular emphasis on the net current assets or working capital. At low points in the general market, a large proportion of common stocks are bargain issues, as measured by these standards. A typical example was General Motors when it sold at less than 30% in 1941, equivalent to only 5% for the 1971 shares. It had been earning in excess of $4 and paying $3.50 or more in dividends. It is true that current earnings and the immediate prospects may both be poor, but a level-headed appraisal of average future conditions. Welcome. Vo of a M4 N Omicron iota, TT Omicron, HE would indicate values far above ruling prices. Thus the wisdom of having courage in depressed markets is vindicated not only by the voice of experience, but also by application of plausible techniques of value analysis. The same vagaries of the marketplace that recurrently establish a bargain condition in the general list account for the existence of many individual bargains at almost all market levels. The market is fond of making mountains out of molehills and exaggerating ordinary vicissitudes into major setbacks. Even a mere lack of interest or enthusiasm may impel a price decline to absurdly low levels. Thus we have what appear to be two major sources of undervaluation. One, currently disappointing results, and two, protracted neglect or unpopularity. However, neither of these causes, if considered by itself alone, can be relied on as a guide to successful common stock investment. How can we be sure that the currently disappointing results are indeed going to be only temporary? True, we can supply excellent examples of that happening. The steel stocks used to be famous for their cyclical quality, and the shrewd buyer could acquire them at low prices when earnings were low and sell them out in years at a fine profit. A spectacular example is supplied by Chrysler Corporation, as shown by the data in Table 7-3. Boom. If this were the standard behavior of stocks with fluctuating earnings, then making profits in the stock market would be an easy matter. Unfortunately, we could cite many examples of declines in Jabil, earnings and price which were not followed automatically by a handsome recovery of both. One such was Anaconda Wire and Cable, which had large earnings up to 1956, with a high price of 85% in that year. The earnings then declined irregularly for 6 years. The price fell to 23% in 1962. And the following year it was taken over by its parent enterprise, Anaconda Corporation, at the equivalent of only 33. The many experiences of this type suggest that the investor would need more than a mere falling off in both earnings and price to give him a sound basis for purchase. He should require an indication of at least reasonable stability of earnings over the past decade or more, i.e., no year of earnings deficit, plus sufficient size and financial strength to meet possible setbacks in the future. The ideal combination here is thus that of a large and prominent company selling both well below its past average price and its past average price, earnings multiplier. This would no doubt have ruled out most of the profitable opportunities in companies such as Chrysler, since their low price years are generally accompanied by high price earnings ratios. But let us assure the reader now, and no doubt we shall do it again, that there is a world of difference between hindsight profits and real money profits. We doubt seriously whether the Chrysler type of roller coaster is a suitable medium for operations by our enterprising investor. We have mentioned protracted neglect or unpopularity as a second cause of price declines to unduly low levels. A current case of this kind would appear to be National Presto Industries. In the bull market of 1968, it sold at a high of 45, which was only 8 times the $5.61 earnings for that year. The per-share profits increased in both 1969 and 1970, but the price declined to only 21 in 1970. This was less than 4 times the record earnings in that year, and less than its net current asset value. In March 1972, it was selling at 34, still only 51.2 times the last reported earnings, and at about its enlarged net current asset value. Another example of this type is provided currently by Standard Oil of California, a concern of major importance. In early 1972, T was selling at about the same price as 13 years before, say 56. Its earnings have been remarkably steady, with relatively small growth but with only one small decline over the entire period. Its book value was about equal to the market price. With this conservatively favorable 1958 to 71 record, the company has never shown an AVER annual price as high as 15 times its current earnings. In early 1972, the price-earnings ratio was only about 10%. Age. A third cause for an unduly low price for a common stock may be the market's failure to recognize its true earnings picture. Our classic example here is Northern Pacific Railway, which in 1946 to 47 declined from 36 to 13%. The true earnings of the road in 1947 were close to $10 per share. The price of the stock was held down in great part by its $1 dividend. It was neglected also because much of its earnings power was concealed by accounting methods peculiar to railroads. The type of bargain issue that can be most readily identified is a common stock that sells for less than the company's net working capital alone after deducting all prior obligations. This would mean that the buyer would pay nothing at all for the fixed assets, buildings, machinery, etc., or any goodwill items that might exist. Very few companies turn out to have an ultimate value less than the working capital alone, although scattered instances may be found. The surprising thing, rather, is that there have been so many enterprises obtainable which have been valued in the market on this bargain basis. A compilation made in 1957, when the market's level was by no means low, disclosed about 150% of such common stocks. In Table 7-4, we summarize the result of buying on December 31st, 1957. One share of each of the 85 companies in that list for which data appeared in Standard Amp, Poor's Monthly Stock Guide, and holding them for 2 years. Groups advanced in by something of a coincidence each of the 2 years to somewhere in the neighborhood of the aggregate net current asset value, the gain for the entire portfolio in that. What is more remarkable is that none of the issues showed signified period was 75% against 50% for Standard Amp, Poor's 425 industrials. Cant losses. 7 held about even, and 78% showed appreciable gains. Our experience with this type of investment selection on a diversified basis was uniformly good for many years prior to 1957. It can probably be affirmed without hesitation that it constitutes a safe and profitable method of determining and taking advantage of undervalued situations. However, during the general market advance after 1957, the number of such opportunities became extremely limited, and many of those available were showing small operating profits or even losses. The market decline of 1969 to 70 produced a new crop of these sub-working capital stocks. We discussed this group in Chapter 15 on stock selection for the enterprising investor. BARGAINISSUE pattern in secondary companies. We have defined a secondary company as one that is not a leader in a fairly important industry. Thus, it is usually one of the smaller concerns in its field, but it may equally well be the chief unit in an unimportant line. By way of exception, any company that has established itself as a growth stock is not ordinarily considered secondary. In the great bull market of the 1920s, relatively little distinction was drawn between industry leaders and other listed issues, provided the latter were of respectable size. The public felt that a middle-sized company was strong enough to weather storms, and that it had a better chance for really spectacular expansion than one that was already of major dimensions. The Depression years 1931 to 32, however, had a particularly devastating impact on the companies below the first rank, either in size or in inherent stability. As a result of that experience, investors have since developed a pronounced preference for industry leaders and a corresponding lack of interest most of the time in the ordinary company of secondary importance. This has meant that the latter group have usually sold at much lower prices in relation to earnings and assets than have the former. It has meant further that in many instances the price has fallen so low as to establish the issue in the bargain class. When investors rejected the stocks of secondary companies, even though these sold at relatively low prices, they were expressing a belief or fear that such companies faced a dismal future. In fact, at least subconsciously, they calculated that any price was too high for them because they were heading for extinction. Just as in 1929, the companion theory for the blue chips was that no price was too high for them because their future possibilities were limitless. Both of these views were exaggerations and were productive of serious investment errors. Actually, the typical middle-sized listed company is a large one when compared with the average privately owned business. There is no sound reason why such companies should not continue indefinitely in operation, undergoing the vicissitudes characteristic of our economy, but earning on the whole a fair return on their invested capital. More, this brief review indicates that the stock market's attitude toward secondary companies tends to be unrealistic and consequently to create in normal times innumerable instances of major undervaluation. As it happens, the World War II period and the post-war boom were more beneficial to the smaller concerns than to the larger ones, because then the normal competition for sales was suspended and the former could expand sales and profit margins spectacularly. Thus, by 1946, the market's pattern had completely reversed itself from that before the war, whereas the lead stocks in the Dow Jones Industrial Average had advanced only 40% from the end of 1938 to the 1946 high Standard & Poor's Index of low-price stocks had shot up no less than 280% in the same period. Speculators and many self-styled investors with the proverbial short memories of people in the stock market were eager to buy both old and new issues of unimportant companies at inflated levels. Thus, the pendulum had swung clear to the opposite extreme, the very class of secondary issues that had formerly supplied by far the largest proportion of bargain opportunities, was presenting the greatest number of examples of over-enthusiasm, ASM, and overvaluation. In a different way, this phenomenon was repeated in 1961 and 1968, the emphasis now being placed on new offerings of the shares of small companies of less than secondary character, and on nearly all companies in certain favored fields such as electronics, computers, franchise concerns, and ERs. As was to be expected, the ensuing market declines fell most heavily on these overvaluations. In some cases, the pendulum swing may have gone as far as definite undervaluation. If most secondary issues tend normally to be undervalued, what reason has the investor to believe that he can profit from such a situation? For if it persists indefinitely, will he not always be in the same market position as when he bought the issue? The answer here is somewhat complicated. Substantial profits from the purchase of secondary companies at bargain prices arise in a variety of ways. First, the dividend return is relatively high. Second, the reinvested earnings are substantial in relation to the price paid and will ultimately affect the price. In a 5 to 7 year period, these advantages can bulk quite large in a well-selected list. Third, a bull market is ordinarily most generous to low-priced issues. Thus, it tends to raise the typical bargain issue to at least a reasonable level. Fourth, even during relatively featureless market periods, a continuous process of price adjustment goes on, under which secondary issues that were undervalued may rise at least to the normal level for their type of security. Fifth, the specific factors that, in many cases made for a disappointing record of earnings, may be corrected by the advent of new conditions or the adoption of new policies, or by a change in management. An important new factor in recent years has been the acquisition of smaller companies by larger ones, usually as part of a diversification program. In these cases, the consideration paid has almost always been relatively generous and much in excess of the bargain. Levels existing not long before, when interest rates were much lower than in 1970, the field of bargain issues extended to bonds and preferred stocks that sold at large discounts from the amount of their claim. Currently, we have a different situation in which even well-secured issues sell at large discounts if carrying coupon rates of, say, 41.2% or less. Example: American Telephone ANDAMP, Telegraph 2%, due 1986, sold as low as 51 in 1970. Dear ANDAMP Company, 41.2s, due 1983, sold as low as 62. These may well turn out to have been bargain opportunities before very long if ruling interest rates should decline substantially. For a bargain bond issue in the more traditional sense, perhaps we shall have to turn once more to the first mortgage bonds of railroads, now in financial difficulties, which sell in the 20s or 30s. Such situations are not for the inexpert investor, lacking a real sense of values. In this area, he may burn his fingers, but there is an underlying 10. Tendency for market decline in this field to be overdone. Consequently, as a whole, offers an especially rewarding invitation to the group careful and courageous analysis. In the decade ending in 1948, the billion-dollar, always and spectacular opportunities in this area, such opportunities of defaulted railroad bonds presented, numer, group, have been quite the 1,970 seconds. Scarce since then, but they seem likely to return in special situations or workouts. Not so long ago, this was a field which could almost guarantee an attractive rate of return to those who knew their way around in it, and this was true under almost any sort of general market situation. It was not actually forbidden territory to members of the general public. Some who had a flair for this sort of thing could learn the ropes and become pretty capable practitioners without the necessity of long academic study or apprenticeship. Others have been keen enough to recognize the underlying soundness of this approach and to attach themselves to bright young men who handled funds devoted chiefly to these special situations. But in recent years, for reasons we shall develop later, the field of arbitrages and workouts became riskier and less profitable. It may be that in years to come, conditions in this field will become more propitious. In any case, it is worthwhile outlining the general nature and origin of these operations with one or two illustrative examples. The typical special situation has grown out of the increasing number of acquisitions of smaller firms by large ones. As the gospel of diversification of products has been adopted by more and more managements, it often appears good business for such an enterprise to acquire an existing company in the field it wishes to enter rather than to start a new venture from scratch. In order to make such acquisition possible and to obtain acceptance of the deal by the required large majority of shareholders of the smaller company, it is almost always necessary to offer a price considerably above the current level. Such corporate moves have been producing interesting profit-making opportunities for those who have made a study of this field and have good judgment fortified by ample experience. A great deal of money was made by shrewd investors not so many years ago through the purchase of bonds of railroads in bankruptcy, bonds which they knew would be worth much more than their cost when the railroads were finally reorganized. After promulgation of the plans of reorganization, a when-issued marquette for the new securities appeared. These could almost always be sold for considerably more than the cost of the old issues which were to be exchanged therefore. There were risks of non-consumer, ONAR 00 Joeshan of the plans or of unexpected delays, but on the whole such arbitrage operations proved highly profitable. There were similar opportunities growing out of the breakup of public utility holding companies pursuant to 1935 legislation. Nearly all these enterprises proved to be worth considerably more when changed from holding companies to a group of separate operating companies. The underlying factor here is the tendency of the security markets to undervalue issues that are involved in any sort of complicated legal proceedings. An old Wall Street motto has been, "Never buy into a lawsuit." This may be sound advice to the speculator seeking quick action on his holdings. But the adoption of this attitude by the general public is bound to create bargain opportunities in the securities affected by it, since the prejudice against them holds their prices down to unduly low levels. The exploitation of special situations is a technical branch of investment which requires a somewhat unusual mentality and equipment. Probably only a small percentage of our enterprising investors are likely to engage in it. And this book is not the appropriate medium for expounding its complications, broader implications of our rules for investment. It's of first place on a choice by the investor of either the defensive pace investment policy, as it has been developed here, depends on the must have a considerable knowledge of security values, enough, aggressive enterprising role, the aggressive investor, in fact, torrent viewing his security operations as equivalento, a business enterprise. There is no room in this philosophy for a or middle ground or a series of gradations between the passive and aggressive status. Many, perhaps most, investors seek to place themselves in such an intermediate category. In our opinion, that is a compromise that is more likely to produce disappointment than achievement. As an investor, you cannot soundly become half a businessman, expecting thereby to achieve half the normal rate of business profits on your funds. It follows from this reasoning that the majority of security owners should elect the defensive classification. They do not have the time, or the determination, or the mental equipment to embark upon investing as a quasi-business. They should therefore be satisfied with the excellent return now obtainable from a defensive portfolio, and with even less. And they should stoutly resist the recurrent temptation to increase this return by deviating into other paths. The enterprising investor may properly embark upon any security operation for which his training and judgment are adequate and which appears sufficiently promising when measured by established business standards. In our recommendations and caveats for this group of investors, we have attempted to apply such business standards. In those for the defensive investor, we have been guided largely by the three requirements of underlying safety, simplicity of choice, and promise of satisfactory results, in terms of psychology as well as arithmetic. The use of these criteria has led us to exclude from the field of recommended investment a number of security classes that are normally regarded as suitable for various kinds of investors. These prohibitions were listed in our first chapter on P30. Let us consider a little more fully than before what is implied in these exclusions. We have advised against the purchase at full prices of three important categories of securities. 1. Foreign bonds. 2. Ordinary preferred stocks. And 3. Secondary common stocks, including, of course, original offerings of such issues. By full prices, we mean prices close to par for bonds or stocks, and prices that represent about the fair business value offered for the enterprise in the case of common stocks. The greater number of defensive investors are to avoid these categories regardless price. The enterprising investor is to buy them only when obtained. Able at bargain prices, which we define as prices not more than 2/3 of the appraisal value of the securities. What would happen if all investors were guided by our advice in these matters? That question was considered in regard to foreign bonds on P138, and we have nothing to add at this point. Investment-grade preferred stocks would be bought solely by corporations, such as insurance companies, which would benefit from the special income tax status of stock issues owned by them. The most troublesome consequence of our policy of exclusion is in the field of secondary common stocks. If the majority of investors, being in the defensive class, are not to buy them at all, the field of possible buyers becomes seriously restricted. Furthermore, if aggressive investors are to buy them only at bargain levels, then these issues would be doomed to sell for less than their fair value. Except to the extent that they were purchased unintelligently, this may sound severe and even vaguely unethical. Yet in truth, we are merely recognizing what has actually happened in this area for the greater part of the past 40 years. Secondary issues, for the most part, do fluctuate about a central level which is well below their fair value. They reach and even surpass that value at times, but this occurs in the upper reaches of bull markets, when the lessons of practical experience would argue against the soundness of paying the prevailing prices for common stocks. Thus, we are suggesting only that the aggressive investor recognize the facts of life as it is lived by secondary issues, and that they accept the central market levels that are normal for that class as their guide in fixing their own levels for purchase. There is a paradox here, nevertheless. The average selected secondary company may be fully as promising as the average industrial leader. What the smaller concern lacks in inherent stability, it may readily make you pin superior possibilities of growth. Con. Consequently, it may appear illogical to many readers to term unintelligent the purchase of such secondary issues at their full enterprise value. We think that the strongest logic is that of experience. Financial history says clearly that the investor may expect satisfactory results on the average from secondary, common, stocks only if he buys them for less than their value, to a private owner, that is, on a bargain basis. The last sentence indicates that this principle relates to the ordinary outside investor, anyone who can control a secondary penny, or who is part of a cohesive group with such control, is fully justified in buying the shares on the same basis as if he were investing in a close corporation or other private business. The distinction between the position and consequent investment policy of insiders and of outsiders becomes more important as the enterprise itself becomes less important. It is a basic characteristic of a primary or leading company that a single detached share is ordinarily worth as much as a share in a controlling block. In secondary companies, the average market value of a detached share is substantially less than its worth to a controlling owner. Because of this fact, the matter of shareholder management relations and of those between inside and outside shareholders tends to be much more important and controversial in the case of secondary than in that of primary companies. At the end of Chapter 5, we commented on the difficulty of making any hard and fast distinction between primary and secondary companies. The many common stocks in the boundary area may properly exhibit an intermediate price behavior. It would not be illogical for an investor to buy such an issue at a small discount from its indicated or appraisal value, on the theory that it is only a small distance away from a primary classification and that it may acquire such a rating unqualifiedly in the not-too-distant future. Thus, the distinction between primary and secondary issues need not be made too precise, for if it were, then a small difference in quality must produce a large differential in justified purchase price. In saying this, we are admitting a middle ground in the classification of common stocks, although we counseled against such a middle ground in the classification of investors. Our reason for this apparent inconsistency is as follows. No great harm comes from some uncertainty of viewpoint regarding a single security, because such cases are exceptional and not a great deal is at stake in the matter. But the investor's choice as between the defensive or aggressive status is of major consequence to him, and he should not allow himself to be confused or compromised in this basic DC. Scion, commentary on Chapter 7. It requires a great deal of boldness and a great deal of caution to make a great fortune, and when you have got it, it requires 10 times as much wit to keep it. Nathan Mayer Rothschild. Timing is nothing. In an ideal world, the intelligent investor would hold stocks only when they are cheap and sell them when they become overpriced, then duck into the bunker of bonds and cash until stocks again become cheap enough to. From 1966 through late 2001, one study claimed $1 held continuously in stocks would have grown to $11.71. But if you had gotten out of stocks right before the 5 worst days of each year, your original $1 would have grown to $987.12. Like most magical market ideas, this one is based on sleight of hand. How exactly would you or anyone figure out which days will? Bet the worst days before they arrive? On January 7th, 1973, the New York Times featured an interview with one of the nation's top financial forecasters, who urged investors to buy stocks without hesitation. It's very rare that you can be as unqualifiedly bullish as you can now. That forecaster was named Alan Greenspan, and it's very rare that anyone has ever been so unqualifiedly wrong as the future Federal Reserve Chairman was that day. 1973 and 1974 turned out to be the worst years for economic growth and the stock market since the Great Depression. 2. Can professionals time the market any better than Alan Greenspan? I see no reason not to think the majority of the decline is behind us, declared Kate Leary Lee, president of the market timing firm of R.M. Leary & Company, on December 3, 2001. This is when you want to be in the market, she added, predicting that stocks look good for the first quarter of 2002. Over the next 3 months, stocks earned a meager 0.28% return, underperforming cash by 0.5 percentage points. Leary is not alone. A study by 2 finance professors at Duke University found that if you had followed the recommendations of the best 10% of all market timing newsletters, you would have earned a 12.6% annualized return from 1991 through 1995. But if you had ignored them and kept your money in a stock index fund, you would have earned 16.4%. Be understood backwards, but it must be lived forwards. Looking as the Danish philosopher Søren Kierkegaard noted, life can only. Back, you can always see exactly when you should have bought and sold your stocks. But don't let that fool you into thinking you can see, in real time, just when to get in and out. In the financial markets, hindsight is forever 20/20ths, but foresight is legally blind. And thus, foremost, investors' market timing is a practical and emotional impossibility. What goes up, like spacecraft that pick up speed as they rise into the Earth's stratosphere, growth stocks often seem to defy gravity. Let's look at the trajectories of 3 of the hottest growth stocks of the 1990s. General Electric, Home Depot, and Sun Microsystems. See Figure 7-1. In every year from 1995 through 1999, each grew bigger and more profitable. Revenues doubled at Sun and more than doubled at Home Depot. According to Value Line, GE's revenues grew 29%. Its earnings rose 65%. At Home Depot and Sun, earnings per share roughly tripled. But something else was happening, and it wouldn't have surprised Graham one bit. The faster these companies grew, the more expensive their stocks became. And when stocks grow faster than companies, investors always end up sorry. As Figure 7-2 shows, a great company is not a great investment if you pay too much for the stock. The more stock has gone up, the more it seems likely to keep going up. But that instinctive belief is flatly contradicted by a fundamental law of financial physics. The bigger they get, the slower they grow. A $1 billion company can double its sales fairly easily, but where can a $50 billion company turn to find another $50 billion in business? Growth stocks are worth buying when their prices are reasonable, but when their price-earnings ratios go much above 25 or 30, the odds get ugly. Journalist Carol Loomis found that from 1960 through 1999, only 8 of the largest 150 companies on the Fortune 500 list aged to raise their earnings by an annual average of at least 15% for 2 decades. Looking at 5 decades of data, the research firm of Sanford C. Bernstein Amp company showed that only 10% of large U.S. companies had increased their earnings by 20% for at least 5 consecutive years. Only 3% had grown by 20% for at least 10 years straight. And not a single one had done it for 15 years in a row. Low.org, an academic study of thousands of U.S. stocks from through found that over all year periods, net earnings grew by an average of 9.7% annually. But for the biggest 20% of companies, earnings grew by an annual average of just 9.3% to 3%. Even many corporate leaders fail to understand these odds. See sidebar on P184. The intelligent investor, however, gets interested in big growth stocks not when they are at their most popular, but when something goes wrong. In July 2002, Johnson announced that regulators were investigating accusations of false record-keep Federal Ingat, one of its drug factories, and the stock lost 16% in a single day. That took jump. J's share price down from 24 times the previous 12 months. Earnings to those 20 times. At that lower level, Johnson Amp, Johnson might once again have become a growth stock with room to grow, making it an example of what Graham calls the relatively unpopular large company. This kind of temporary unpopularity can create lasting wealth by enabling you to be a great company at a good price. High potential for hype potential. Investors aren't the only people who fall prey to the delusion that hypergrowth can go on forever. In February 2000s, Chief Executive John Roth of Nortel Networks was asked how much bigger his giant fiber optics company could get. The industry is growing 14% to 15% a year, Roth replied, and we're going to grow 6 points faster than that. For a company our size, that's pretty heady stuff. Nortel stock, up nearly 51% annually over the previous 6 years, was then trading at 87 times what Wall Street was guessing it might earn in 2000s. Was the stock overpriced? It's getting up there, shrugged Roth, but there's still plenty of room to grow our valuation as we execute on the wireless strategy. After all, he added, Cisco Systems was trading at 121 times its projected earnings. As for Cisco, in November 2000s, its chief executive, John Chambers, insisted that his company could keep growing at least 50% annually. Logic, he declared, would indicate this is. A breakaway Cisco stock had come way down. It was then trading at a mere 98 times its earnings over the previous year, and Chambers urged investors to buy. So who are you going to bet on? He asked. Now may be the opportunity. Year, Cisco's. Instead, these growth companies shrank and their overpriced stocks shriveled. Nortel's revenues fell by 37% in 2001, and the company lost more than $26 billion that. Revenues did rise by 18% in 2001, but the company ended up with a net loss of more than $1 billion. Nortel's stock, at $113.50 when Roth spoke, finished 2002 at $1.65. Cisco's shares at $52 when Chambers called his company away crumbled to $13. A break. Both companies have since become more circumspect about forecasting the future. Should you put all your eggs in one basket? Put all your eggs into one basket and then watch that basket, proclaimed Andrew Carnegie a century ago. Do not scatter your shot. The great successes of life are made by concentration. As Graham points out, the really big fortunes from common stocks have been made by people who packed all their money into one investment they knew supremely well. Nearly all the richest people in America trace their wealth to a concentrated investment in a single industry or even a single company. Think Bill Gates and Microsoft, Sam Walton and Walmart, or the Rockefellers and Standard Oil. The Forbes 400 list of the richest Americans, for example, has been dominated by undiversified fortunes ever since it was first compiled in 1982. However, almost no small fortunes have been made this way, and not many big fortunes have been kept this way. What Carnegie neglected to mention is that concentration also makes most of the great failures of life. Look again at the Forbes Rich list. Back in 1982, the average net worth of a Forbes 400 member was $230 million. To make it onto the 2002 Forbes 400, the average 1982 member needed to earn only a 4.5% average annual return on his wealth during a period when even bank accounts yielded far more than that, and the stock market gained an annual average of 13.2%. So how many of Forbes 400 fortunes from 1982 remained on the list 20 years later? Only 64 of the original members. A measly 16% were still on the list in 2002. By keeping all their eggs in the one basket that had gotten them onto the list in the first place once, booming industries like oil and gas or computer hardware. Or basic. Manufacturing, all the other original members fell away when hard times hit none of these people, despite all the huge advantages that great wealth can. Stand by and wince at the sickening crunch as the constantly Chang Ind economy crushed their only basket and all their eggs. 10. Bring were properly prepared. They could only. Forbes. The bargain bin. You might think that in our endlessly networked world it would be. Cinch to build and buy a list of stocks that meet Graham's criteria for bargains, P169, although the internet is a help, you'll still have Toto, much out the work by hand. Grab a copy of today's Wall Street Journal, turn to the money investing section, and take a look at the NYSE and NASDAQ score cards to find the day's list of stocks that have hit new lows. For the past year, a quick and easy way to search for companies that might pass Graham's net working capital tests. Online, try HTTP, quote, morningstar.com/highlow.html, section high-low, to see whether a stock is selling for less than the value of net working capital, what Graham's followers call net nets. Download or request the most recent quarterly or annual report from the company's website or from the EDGAR database at www.sec.gov. From the company's current assets, subtract its total liabilities, including any preferred stock and long-term debt. Or consult your local public library's copy of the Value Line Investment Survey, saving yourself a costly annual subscription. Each issue carries a list of bargain basement stocks that come close to Graham's definition. Most of these stocks lately have been in bombed-out areas like high-tech and telecommunications. As of October 31st, 2002, for instance, Converse Technology had $2.4 billion in current assets and $1 billion in total liabilities, giving it $1.4 billion in net working capital, with fewer than 190 million shares of stock and a stock price under $8 per share. Converse had a total market capitalization of just under $1.4 billion. With the stock priced at no more than the value of Converse's cash and inventories, the company's ongoing business was essentially selling for nothing. As Graham knew, you can still lose money on a stock like Converse, which is why you should buy them only if you can find a couple dozen ATA time and hold them patiently. But on the very rare occasions when Mr. Market generates that many true bargains, you're all but certain to make money. What's your foreign policy? Investing in foreign stocks may not be mandatory for the intelligent investor, but it is definitely advisable. Why? Let's try a little thought experiment. It's the end of 1989, and you're Japanese. Here are the facts. Over the past 10 years, your stock market has gained an annual average of 21.2%, well ahead of the 17.5% annual gains in the United States. Japanese companies are buying up everything in the United States, from the Pebble Beach golf course to Rockefeller Center. Meanwhile, American firms like Drexel Burnham Lambert, Financial Corp of America, and Texaco are going bankrupt. The U.S. high-tech industry is dying. Japan's is booming. In 1989, in the land of the rising sun, you can only conclude that investing outside of Japan is the dumbest idea since sushi vending. Machines. Naturally, you put all your money in Japanese stocks. The results? Over the next decade, you lose roughly 2/3 of your money. The lesson? It's not that you should never invest in foreign markets like Japan. It's that the Japanese should never have kept all their money at home. And neither should you if you live in the United States, work in the United States, and get paid in US dollars. You are already making a multi-layered bet on the US economy. To be prudent, you should put some of your investment portfolio elsewhere, simply because no one anywhere can ever know what the future will bring at home or abroad. Putting up to 1/3 of your stock money in mutual funds that hold foreign stocks, including those in emerging markets, helps insure against the risk that our own backyard may not always be the best place in the world to invest. 0097 to Bro. Chapter 8. The investor and market fluctuations. Success near B-highs. Marks and recur invest these to the extent that the investor's funds are placed in high-grade bonds of relatively short maturity, say of 7 years or less. He will not be affected significantly by changes in market prices and need not take them into account. This applies also to his holdings. OFUS savings bonds, which he can always turn in at his cost price or more. His longer-term bonds may have relatively wide price swings during their lifetimes, and his common stock portfolio is almost certain to fluctuate in value over any period of several years. The investor should know about these possibilities and should be prepared for them both financially and psychologically. He will want to benefit from changes in market levels, certainly through an advance in the value of his stock holdings as time goes on, and perhaps also by making purchases and sales at advantageous prices. This interest on his part is inevitable and legitimate enough. But it involves the very real danger that it will lead him into speculative attitudes and activities. It is easy for us to tell you not to speculate. The hard thing will be for you to follow this advice. Let us repeat what we said at the outset. If speculate, do so with your eyes open, knowing that you want it will proba. Bly lose money in the end. Be sure to limit the amount at risk and 2. Separate it completely from your investment program. We shall deal first with the more important subject of price changes in common stocks and pass later to the area of bonds. In Chapter 3, we supplied a historical survey of the stock market's action over the past 100 years. In this section, we shall return to that material from time to time in order to see what the past record promises the investor in either the form of long-term appreciation of a portfolio held relatively unchanged through EM by TI stock to B is DUE, the passive soulev, FA if WRAB, successive, rises and declines, or in the possibilities of buying near bear market, lows and selling not too far below bull market, highs, market fluctuations, as a guide to investment decisions, since common stocks, even of investment grade, are subject to recurrent and wide fluctuations in their prices. The intelligent investor should be interested in the possibilities of profiting from these pendulum swings. There are two possible ways by which he may try to do this: the way of timing and the way of pricing. By timing, we mean the endeavor to anticipate the action of the stock market to buy or hold when the future course is deemed to be upward, to sell or refrain from buying when the course is downward. By pricing, we mean the endeavor to buy stocks when they are quoted below their fair value and to sell them when they rise above such value. A less ambitious form of pricing is the simple effort to make sure that when you buy, you do not pay too much for your stocks. This may suffice for the defensive investor, whose emphasis is on long pull holding, but as such it represents an essential minimum of attention to market levels. We are convinced that the intelligent investor can derive status factory results from pricing of either type. We are equally sure that if he places his emphasis on timing, in the sense of forecasting, he will end up as a speculator and with a speculator's financial results. This distinction may seem rather tenuous to the layman, and it is not commonly accepted on Wall Street as a matter of business practice or perhaps of thoroughgoing conviction. The stockbrokers and the investment services seem wedded to the principle that both investors and speculators in common stocks should devote careful attention to market forecasts. We'll find, we believe, as to the pretensions of stock market forecast. The farther one gets from Wall Street, the more skepticism. 1. Engordiming. The investor can scarcely take seriously the innumerable able predictions which appear almost daily and are his for the asking. Yet in many cases he pays attention to them and even acts upon them. Why? Because he has been persuaded that it is important for him to form some opinion of the future course of the stock. www.lo.org market. And because he feels that the brokerage or service forecast is at least more dependable than his own. We lack space here to discuss in detail the pros and cons of market forecasting. A great deal of brainpower goes into this field, and undoubtedly some people can make money by being good stock market analysts. But it is absurd to think that the general public can ever make money out of market forecasts. For who will buy when the general public at a given signal rushes to sell out at a profit? If you, the reader, expect to get rich over the years by following some system or leadership in market forecasting, you must be expecting to try to do what countless others are aiming at, and to be able to do it better than your numerous competitors in the market. There is no basis either in logic or in experience for assuming that any typical or average investor can anticipate market movements more successfully than the general public. of which he is himself a part. There is one aspect of the timing philosophy which seems to have escaped everyone's notice. Timing is of great psychological importance to the speculator because he wants to make his profit in a hurry. The idea of waiting a year before stock moves up is repugnant to him, but a waiting period as such is of no consequence to the investor. What advantage is there to him in having his money uninvested until he receives some, presumably, trustworthy signal that the time has come to buy? He enjoys an advantage only if by waiting he succeeds in buying later at a sufficiently lower price to offset his loss of dividend income. What this means is that timing is of no real value to the investor unless it coincides with pricing, that is, unless it enables him to repurchase his shares at substantially under his previous selling price. In this respect, the famous Dow theory for timing purchases and sales has had an unusual history. Briefly, this technique takes its signal to buy from a special kind of breakthrough the stock averages on the upside, and its selling signal from a similar breakthrough on the downside. The calculated, not necessarily actual results of using this method showed an almost unbroken series of profits in operations from 1897 to the early 1960s. On the basis of this presentation, the practical value of the Dow theory would have appeared firmly established. The doubt, if applied to the dependability of this published record, as a picture of what a Dow theorist would actually have done in the market. A closer study of the figures indicates that the quality of the results shown by the Dow theory changed radically after 1938 too. A few years after the theory had begun to be taken seriously on Wall Street. Its spectacular achievement had been in giving a sell signal at 306 about a month before the 1929 crash, and in keeping its followers out of the long bear market until things had pretty well righted themselves at 84 in 1933. But from 1938 on, the Dow theory operated mainly by taking its practitioners out at a pretty good price, but then putting them back in again at a higher price. For nearly 30 years thereafter, one would have done appreciably better by just buying and holding the DJIA to the in. The Dow theory results is not accidental. It demonstrates an inherent characteristic of forecasting and trading formulas in the fields of business and finance. Those formulas that gain adherence and sometimes merely because they have been plausibly adapted to importance do so because they have worked well over a period or statistical record of the past. But as their acceptance increases, their reliability tends to diminish. This happens for two reasons. First, the passage of time brings new conditions which the old formula no longer fits. Second, in stock market affairs, the popularity of a trading theory has itself an influence on the market's behavior which detracts in the long run from its profit-making possibilities. The popularity of something like the Dow theory may seem to create its own vindication, since it would make the market advance or decline by the very action of its followers when a buying or selling signal is given. A stampede of this kind is, of course, much more of a danger than an advantage to the public trader. Buy low, sell high approach. We are convinced that the average investor cannot deal successfully with price movements by endeavoring to forecast them. Can he benefit from them after they have taken place? i.e., by buying after each major decline and selling out after each major advance? The fluctuations of the market over a period of many years prior to 1950 lent considerable encouragement to that idea. In fact, a classic definition of a shrewd investor was one who bought in a bear market when everyone else was selling and sold out in a bull market when everyone else was buying. If we examine our chart I covering the fluctuations of the Standard & Poor's Composite Index between 1900s and 1970, and the supporting figures in Table 3-1, P66, we can readily see why this viewpoint appeared valid until fairly recent years. Between 1897 and 1949, there were 10 complete market cycles, running from bear market low to bull market high and back to bear market low. 6 of these took no longer than 4 years. 4 ran for 6 or 7 years, and one to the famous New Era Cycliff 1921-1932 lasted 11 years. The percentage of advance from the lows to highs ranged from 44% to 500%, with most between about 50% and 100%. The percentage of subsequent declines ranged from 24% to 89%, with most found between 40% and 50%. It should be remembered that a decline of 50% fully offsets a preceding advance of 100%. Nearly all the bull markets had a number of well-defined characteristics in common, such as 1. A historically high price level, 2. High price earnings ratios, 3. Low dividend yields as against bond yields, 4. Much speculation on margin, and 5. Many offerings of new common stock issues of poor quality. Thus, to the student of stock market history, it appeared that the intelligent investor should have been able to identify the recurrent bear and bull markets, to buy in the former and sell in the latter, and to do so for the most part at reasonably short intervals of time. Various methods were developed for determining buying and selling levels of the general market based on either value factors or percentage movements of prices, or both. But we must point out that even prior to the unprecedented bull market that began in 1949, there were sufficient variations in the successive market cycles to complicate and sometimes frustrate the of buying low and selling high. The most notable, desirable process of these departures, of course, was the great bull market of the late 1920s, which threw all calculations badly out of gear, even in 1949. Therefore, it was by no means a certainty that the investor could base his financial policies and procedures mainly on the endeavor to buy at low levels in bear markets and to sell out at high levels. In bull markets, it turned out in the sequel that the opposite was true, the wing to market's behavior in the past. 20 years has not followed the former pattern nor obeyed what once were well established danger sig, nals, nor permitted its successful exploitation by applying old rules for buying low and selling high. Whether the old, fairly regular bull and bear market pattern will eventually return, we do not know. But it seems unrealistic to us for the investor to endeavor to base his present policy on the classic formula, i.e., to wait. 4. Demonstrable bear market levels before buying any common stocks. Our recommended policy has, however, made provision for changes in the proportion of common stocks to bonds in the portfolio. If the investor chooses to do so, according as the level of stock prices appears less or more attractive by value standards. Formula plans. In the early years of the stock market rise that began in 1949, to 50% considerable interest was attracted to various methods of taking advantage of the stock market cycles. These have been known as formula investment plans. The essence of all such plans, except the simple case of dollar averaging, is that the investor automatically does some selling of common stocks when the market advances substantially. In many of them, a very large rise in the market level would result in the sale of all common stock holdings. Others provided for retention of a minor proportion of equities under all circumstances. This approach had the double appeal of sounding logical and conservative, and of showing excellent results when applied retrospectively to the stock market over many years in the past. Unfortunately, its vogue grew greatest at the very time when it was destined to work least well. Many of the formula planners found themselves entirely or nearly out of the stock market at some level in the middle 1950s. True, they had realized excellent profits, but in a broad sense the market ran away from them thereafter, and their formulas gave them little opportunity to buy back a common stock position. There is a similarity between the experience of those adopting the formula investing approach in the early 1950s and those who embraced the purely mechanical version of the Dow theory some 20 years earlier. In both cases, the advent of popularity marked almost the exact moment when the system ceased to work well. We have had a discomforting experience with our own central value method of determining indicated buying and selling levels of the Dow Jones Industrial Average. The moral seems to be that any approach to money making in the stock market, which can be easily described and followed by a lot of people, is by its terms too simple and too easy to last. Spinoza's concluding remark applies to Wall Street as well as to philosophy. All things excellent are as difficult as they are rare. Market fluctuations of the investor's portfolio, every investor who owns common stocks must expect to see them fluctuate in value over the years. The behavior of the DJIA. Well, what has happened to the stock portfolio of a conservative? Since our last edition was written in 1964, probably reflects pretty. Investor who limited his stock holdings to those of large, prominent, and conservatively financed corporations. The overall value advanced from an average level of about 890 to a high of 995 in 1966 and 985 again in 1968, fell to 631 in 1970, and made an almost full recovery to 940 in early 1971. Since the individual issues set their high and low marks at different times, the fluctuations in the Dow Jones Group as a whole are less severe than those in the separate components. We have traced through the price fluctuations of other types of diversified and conservative common stock portfolios, and we find that the overall results are not likely to be markedly different from the above. In general, the shares of second-line companies fluctuate more widely than the major ones. But this does not necessarily mean that a group of well-established but smaller companies will make a poorer showing over a fairly long period. In any case, the investor may as well resign himself in advance to the probability rather than the mere possibility that most of his holdings will advance, say, 50% or more from their low point and decline the equivalent one-third or more from their high point at various periods in the next 5 years. Or a serious investor is not likely to believe that the day-to-day, even month-to-month fluctuations of the stock market make him richer or poorer. But what about the longer-term and wider changes? Here, practical questions present themselves. Anthepsy. Geological problems are likely to grow complicated. A substantial rise in the market is at once a legitimate reason for satisfaction and a cause for prudent concern, but it may also bring a strong temptation toward imprudent action. Your shares have advanced. Good, you're a reeker. Then you were good, but has the price risen too high? And should you think of selling? Or should you kick yourself for not having bought more shares when the level was lower? Or worse thought of all, should you now give way to the bull market atmosphere, become infected with the enthusiasm, the overconfidence, and the greed of the great public, of which, after all, you are a part, and make larger and dangerous commitments? Presented thus in print, the answer to the last question is a self-evident no. But even the intelligent investor is likely to need considerable willpower to keep from following the crowd. It's for these reasons of human nature, even more than by calculation of financial gain or loss, that we favor some kind of mechanical method for varying the proportion of bonds to stocks in the investor's portfolio. The chief advantage, perhaps, is that such a formula will give him something to do. As the market advances, he will, from time to time, make sales out of his stock holdings, putting the proceeds into bonds. As it declines, he will reverse the procedure. These activities will provide some outlet for his otherwise too pent-up energies. If he is the right kind of investor, he will take added satisfaction from the thought that his operations are exactly opposite from those of the crowd. Business valuations versus stock market valuations, the impact of market fluctuations upon the investor's true situation may be considered also from the standpoint of the shareholder as the part owner of various businesses. The holder of marketable shares actually has a double status, and with it the privilege of taking advantage of either at his choice. On the one hand, his position is analogous to that of a minority shareholder or silent partner in a private business. Here his results are entirely underlying value of its assets. He would usually determine the eye on the profits of the enterprise or on a change in the value of such a private business interest by calculating his share of the net worth as shown in the most recent balance sheet. On the other hand, the common stock investor holds a piece of paper, an engraved stock certificate, which can be sold in a matter of minutes t, a price which varies from moment to moment when the market is open. That is, and often is far removed from the balance sheet value. The development of the stock market in recent decades has made the typical investor more dependent on the course of price quotations and less free than formerly to consider himself merely a business owner. The reason is that the successful enterprises in which he is likely to concentrate his holdings sell almost constantly at prices well above their net asset value or book value or balance sheet value. In paying these market premiums, the investor gives precious hostages to fortune, for he must depend on the stock market itself to validate his commitments to you. This is a factor of prime importance in present-day investing, and it has received less attention than it deserves. The whole structure of stock market quotations contains a built-in contradiction. The better a company's record and prospects, the less relationship the price of its shares will have to their book value. But the greater the premium above book value, the less certain the basis after mining its intrinsic value, i.e., the more this value will depend on the changing moods and measurements of the stock market. Thus we reach the final paradox that the more successful the Khan's penny, the greater are likely to be the fluctuations in the price of its shares. This really means that, in a very real sense, the better QA, CFMB, quality of a common stock, the more speculative it is likely to be, at least as compared with the unspectacular middle grade issues. What we have said applies to a comparison of the leading growth companies with the bulk of well-established concerns. We exclude from our purview here those issues which are highly speculative, because the businesses themselves are speculative. The argument made above should explain the often erratic price behavior of our most successful and impressive enterprises. Our favorite example is the monarch of them all, international business machines. The price of its shares fell from 607 to 307 months in 1962 to 63. After two splits, its price fell from 387 to 219 in 1970. Similarly, Xerox, an even more impressive earnings gainer in recent decades, fell from 171 to 87 in 1962 to 63, and from 116 to 65 in 1970. These striking losses did not indicate any doubt about the future long-term growth of IBM or Xerox. They reflected instead Ked itself had placed on these excellent prospects a lack of confidence in the premium valuation that the stock market. The previous discussion leads us to a conclusion of practical importance to the conservative investor in common stocks, if he is to pay some special attention to the selection of his portfolio. It might be best for him attention that the initial selling at a reason more than 1/3 above that figure. Purchases made at such levels or lower may with logic be regarded as related to the 200 the INSIS company's balance sheet and as having a justification or support independent of the fluctuating market prices. The premium over book value that may be involved can be considered as a kind of extra fee paid for the advantage of stock. Exchange listing and the marketability that goes with it. A caution is needed here. A stock does not become a sound investment merely because it can be bought at close to its asset value. The investor should demand, in addition, a satisfactory ratio of earnings to price, a sufficiently strong financial position, and the prospect that its earnings will at least be maintained over the years. This may appear like demanding a lot from a modestly priced stock, but the prescription is not hard to fill under all but dangerously high market conditions. Once the investor is willing to forego brilliant prospects, i.e., better than average expected growth, he will have no difficulty in finding a wide selection of issues meeting these criteria. In our chapters on the selection of common stocks, chapters 14 and 15, we shall give data showing that more than half of the DJI issues met our asset value criterion at the end of 1970. The most widely held investment of all, American Tel, and AMP, Tel, actually sells below its tangible asset value as we write. Most of the light and power shares, in addition to their other advantages, are now early 1972 available at prices reasonably close to their asset values. The investor with a stock portfolio having such book values behind it can take a much more independent and detached view of stock market fluctuations than those who have paid high multipliers of both earnings and tangible assets. As long as the earning power of his holdings remains satisfactory, he can give as little attention as he pleases to the vagaries of the stock market. More than that, at times he can use these vagaries to play the master game of buying low and selling high. The A and P example. At this point, we shall introduce one of our original examples, which dates back many years, but which has a certain fascination for us because it combines so many aspects of corporate and investment experience. It involves the Great Atlantic AMP Pacific TIA. Company here is the story. AMP-P shares were introduced to trading on the CURB market, now at the American Stock Exchange, in 1929 and sold as high as 494. By 1932, they had declined to 104, although the company's earnings were nearly as large in that generally catastrophic years previously. In 1936, the range was between 111 and 131. Then, in the business recession and bear market of 1938, the shares fell to a new low of 36. That price was extraordinary. It meant that the preferred and common were together selling for $126 million. Although the company had just reported that it held $85 million in cash alone and a working capital or net current assets of $134 million. AMP-P was the largest retail enterprise in America, if not in the world, with a continuous and impressive record of large earnings for many years. Yet in 1938, this outstanding business was considered on Wall Street to be worth less than its current assets alone, which means less as a going concern than if it were liquidated. Why? First, because there were threats of special taxes on chain stores. Second, because net profits had fallen off in the previous year. And third, because the general market was depressed. The first of these reasons was an exaggerated and eventually groundless fear. The other two were typical of temporary influences. Let us assume that the investor had bought A and P common in 1937 at, say, 12 times its 5-year average earnings, or about 80%. We are far from asserting that the ensuing decline to 36 was of no importance to him. He would have been well advised to scrutinize the picture with some care to see whether he had made any miscalculations. But if the results of his study were reassuring, as they should have been, he was entitled then to disregard the market decline as a temporary vagary of finance, unless he had the funds and the courage to take advantage of it by buying more on the bargain basis offered. Sequel and reflections the following year, 1939, A and P shares advanced to 117%, or 3 times the low price of 1938 and well above the average of 1,937. Such a turnabout in the behavior of common stocks is by no than most. In the years after 1949, the grocery chains shares rose, means uncommon, but in the case of A and P, it was more striking. With the general market until in 1961, the split-up stock 10-for-1 reached a high of 70%, which was equivalent to 705 for the 1938 shares. This price of 70% was remarkable for the fact it was 30 times the earnings of 1961. Such a price-earnings ratio, which compares with 23 times for the DJIA in that year, must have implied expectations of a brilliant growth in earnings. This optimism had no justification in the company's earnings record in the preceding years, and it proved completely wrong. Instead of advancing rapidly, the course of earnings in the ensuing period was generally downward. The year after the 70% high, the price fell by more than half to 34. But this time, the shares did not have the bargain quality that they showed at the low quotation in 1938. After varying sorts of fluctuations, the price fell to another low of 21% in 1970 and 18 in 1,972, having reported the first quarterly deficit in its history. We see in this history how wide can be the vicissitudes of a major American enterprise in little more than a single generation, and also with what miscalculations and excesses of optimism and pessimism the public has valued its shares. In 1938, the business was really being given away, with no takers. In 1961, the public was clamoring for the shares at a ridiculously high price. After that came a quick loss of half the market value, and some years later, a substantial further decline. In the meantime, the company Wosto turned from an outstanding to a mediocre earnings performer. It's a series of confusing small stock dividends not warranted by current additions to surplus and so forth. A&P was a larger com. Penny in 1961 and 1972 than in 1938, but not as well run, not as profitable, and not as attractive. There are two chief morals to this story. The first is that the stock market often goes far wrong, and sometimes an alert and Kura. GS investor can take advantage of its patent errors. The other is that most businesses change in character and quality over the years, sometimes for the better, perhaps more often for the worse. The investor need not watch his company's performance like a hawk, but he should give it a good hard look from time to time. Let us return to our comparison between the holder of marketable shares and the man with an interest in a private business. We have said that the former has the option of considering himself merely as the part owner of the various businesses he has invested in, or as the holder of shares which are saleable at any time he wishes at their quoted market price. But note this important fact: the true investor scarcely ever is forced to sell his shares, and at all other times he is free to disregard the current price quotation. He need pay attention to it and act upon it only to the extent that it suits his book, and no more. Thus, the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. That man would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other persons' mistakes of judgment. Incidentally, a widespread situation of this kind actually existed during the Dark Depression days of 1931 to 1933. There was then a psychological advantage in owning business interests that had no quoted market. For example, people who owned first mortgages on real estate that continued to pay interest were able to tell themselves that their investments had kept their full value, there being no market quotations to indicate otherwise. On the other hand, many listed corporation bonds of even better quality and greater underlying strength suffered severe shrinkages in their market quotations, thus making their owners believe they were growing distinctly poorer. In reality, the owners were better off with the listed securities despite the low prices of these. For if they had wanted to, or were compelled to, they could at least have sold the issues, possibly to exchange them for even better bargains. Or they could just as logically have ignored the market's action as temporary and basically meaningless. But it is self-deception to tell yourself that you have suffered no shrinkage in value merely because your securities have no quoted market at all. Returning to our A&P shareholder in 1938, we assert that as long as he held on to his shares, he suffered no loss in their price decline, beyond what his own judgment may have told him was occasioned by a shrinkage in their underlying or intrinsic value. If no such shrinkage had occurred, he had a right to expect that in due course the market quotation would return to the 1937 level or better, as in fact it did the following year. In this respect, his position was at least as good as if he had owned an interest in a private business with no quoted market for its shares. For in that case too, he might or might not have been justified in mentally lopping off part of the cost of his holdings because of the impact of the 1938 recession, depending on what had happened to his company. Critics of the value approach to stock investment argue that listed common stocks cannot properly be regarded or appraised in the same way as an interest in a similar private enterprise, because the presence of an organized security market injects into equity ownership the new and extremely important attribute of liquidity. But what this liquidity really means is, first, that the investor has the benefit of the stock market's daily and changing appraisal of his holdings for whatever that appraisal may be worth, and second, that the investor is able to increase or decrease his investment at the market's daily figure if he chooses. Thus, the existence of a quoted market gives the investor certain options that he does not have if his security is unquoted. But it does not impose the current quotation on an investor who prefers to take his idea of value from some other source. Let us close this section with something in the nature of a parable. Imagine that in some private business you own a small share that costs you $1,000. One of your partners, named Mr. Market IS, 5th C, 5th A, 5th WTO, ARWACR, very obliging. Indeed, every day he tells you what he thinks your interest is worth, and furthermore offers either to buy you out or to sell you an additional interest on that basis. Sometimes his idea of value appears plausible and justified by business developments and prospects, as you know them. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away with him, and the value he proposes seems to you a little short of silly. If you are a prudent investor or a sensible businessman, will you let Mr. Market's daily communication determine your view of the value of a $1,000 interest in the enterprise? Only in case you agree with him or in case you want to trade with him. You may be happy to sell out to him when he quotes you a ridiculously high price, and equally happy to buy from him when his price is low. But the rest of the time, you will be wiser to form your own ideas of the value of your holdings based on full reports from the company about its operations and financial position. The true investor is in that very position when he owns a listed common stock. He can take advantage of the daily market price or leave it alone, as dictated by his own judgment and inclination. He must take cognizance of important price movements, for otherwise his judgment will have nothing to work on. Conceivably, they may give him a warning signal which he will do well to heed. This in plain English means that he is to sell his shares because the price has gone down, foreboding worse things to come. In our view, such signals are misleading at least as often as they are helpful. Basically, price fluctuations have only one significant meaning for the true investor. They provide him with an opportunity to buy wisely when prices fall sharply and to sell wisely when they advance a great deal. At other times, he will do better if he forgets about the stock market and pays attention to his dividend, returns, and to the operating results of his companies. Summary: Euler's found in their attitude toward stock market movements the most realistic distinction between the investor and the spec. The speculator's primary interest lies in anticipating and profiting from market fluctuations. The investor's primary interest lies in acquiring and holding suitable securities at suitable prices. Market. They alternately create low price levels at which he would be wise to buy and high price levels at which he certainly should refrain from buying and probably would be wise to sell. It is far from certain that the typical investor should regularly hold off buying until low market levels appear, because this involves a long wait, very likely the loss of income, and the possible missing of investment opportunities. On the whole, it may be better for the investor to do his stock buying whenever he has money to put in stocks, except when the general market level is much higher than can be justified by well-established standards of value. If he wants to be shrewd, he can look for the ever-present bargain opportunities in individual securities. Aside from forecasting the movements of the general market, much effort and ability are directed on Wall Street towards selecting stocks or industrial groups that in matter of price will do better than the rest. Over a fairly short period in the future, logical as this endeavor may seem, we do not believe it is suited to the needs or temperament of the true investor, particularly since he would be competing with a large number of stock market traders and first-class financial analysts who are trying to do the same. As in all other activities that emphasize price movements first and underlying values second, the work of many intelligent minds constantly engaged in this field tends to be self-neutralizing and self-defeating over the years. The investor with a portfolio of sound stocks should expect their prices to fluctuate and should neither be concerned by sizable declines nor become excited by sizable advances. He should always remember that market quotations are there for his convey, needs either to be taken advantage of or to be ignored. He should never buy a stock because it has gone up or sell one because it has gone down. He would not be far wrong if this motto read more simply: never buy a stock immediately after a substantial rise of sell one immediately after a substantial drop. An added consideration. Something should be said about the significance of average RMR judges whether his own investment has been successful in terms both of dividends received and of the long-range trend of the age market value. The same criteria should logically be applied in testing the effectiveness of a company's management and the soundness of its attitude toward the owners of the business. This statement may sound like a truism, but it needs to be emphasized. For as yet, there is no accepted technique or approach by which management is brought to the bar of market opinion. On the contrary, managements have always insisted that they have no responsibility of any kind for what happens to the market value of their shares. It is true, of course, that they are not accountable for Those fluctuations in price which, as we have been insisting, bear no relationship to underlying conditions and values. But it is only the lack of alertness and intelligence among the rank and file of share holders that permits this immunity to extend to the entire realm of market quotations, including the permanent establishment of a depreciated and unsatisfactory price level. Good managements produce a good average market price, and bad managements produce bad market prices. Fluctuations in bond prices. The investor should be aware that even though safety of its principal and interest may be unquestioned, a long-term bond could vary widely in market price in response to changes in interest rates. In Table 8-1, we give data for various years back to 1902 covering yields for high-grade corporate and tax-free issues. As individual illustrations, we add the price fluctuations of two representative railroad issues for a similar period. These are the Atchison, Topeka, and Damp Santa Fe General Mortgage 4 seconds, due 1995 for generations 1 of our premier non-callable bond issues and the Northern Pacific Rye. 3 seconds due 2047, originally a 152-year maturity, long a typical barrated bond. Because of their inverse relationship, the low yields correspond to the high prices, and vice versa. The decline in the Northern Pacific 3 seconds in 1940 represented mainly doubts as to the safety of the UE. It is extraordinary that the price recovered to an all-time high the next few years, and then lost 2/3 of its price, chiefly cause of the rise in general interest rates. There have been staggering variations as well in the price of even the highest grade bonds in the past 40 years. Note that bond prices do not fluctuate in the same inverse proportion as the calculated yields, because their fixed maturity value E 100% exerts a moderating influence. However, for very long maturities, as in our Northern Pacific example, prices and yields range at close to the same rate. Earlier, since 1964, record movements in both directions have taken place in the high-grade bond market. Taking prime municipals, tax-free, as an example, their yield more than doubled, from 3.2% in January 1965 to 7% in June 1970. Their price index declined, correspondingly, from 110.8 to 67.5. In mid to 1970, the yields on high-grade long-term bonds were higher than at any time in the nearly 200 years of this country's economic history. 25 years USD before our protracted bull market began, bond yields were at their lowest point in history. Long-term municipals returned as little as 1%, and industrials gave 2.4% compared with the 4% to 5% formerly considered normal. Those of us with a long experience Wall Street had seen Newton's law of action and reaction. Equal and opposites work itself out repeatedly in the stock market, the most noteworthy example being the rise in the DJIA from 64 in 1921 to 381 in 1929, followed by a record collapse to 41 in 1932. But this time, the widest pendulum swings took place in the usually staid and slow-moving array of high-grade bond prices and yields. Moral: nothing important on Wall Street can be counted on to occur exactly in the same way as it happened before. This repair on. Since the first half of our favorite dictum, the more it changes, the more it's the same thing. If it is virtually impossible to make worthwhile predictions about the price movements of stocks, it is completely impossible to do so for bonds. In the old days, at least, one could often find a useful clue to the coming end of a bull or bear market by studying the prior action of bonds, but no similar clues were given to a coming change in interest rates and bond prices. Hence, the investor must choose between long-term and short-term bond investments on the basis chiefly of his personal preferences. If he wants to be certain that the market values will not decrease, his best choices are probably U.S. savings bonds, Series E or H, which were described above P93. Either issue will give him a 5% yield after the first year, the Series E for up to 5% years, the Series H for up to 10 years, with a guaranteed resale value of cost or better. If the investor wants the 7.5% now available on good long-term corporate bonds or the 5.3% on tax-free municipals, you must be prepared to see them fluctuate in price. Banks and insurance companies have the privilege of valuing high-rated bonds of this type. On the mathematical basis of amortized cost, which disregards market prices, it would not be a bad idea for the individual investor to do something similar. The price fluctuations of convertible bonds and preferred stocks are the resultant of three different factors. 1. Variations in the price of the related common stock. 2. Variations in the credit standing of the company. And 3. Variations in general interest rates. A good many of the convertible issues have been sold by companies that have credit ratings well below the best. Some of these were badly affected by the financial squeeze in 1970. As a result, convertible issues as a whole have been subjected to triply unsettling influences in recent years, and price variations have been unusually wide. In the typical case, therefore, the investor would delude himself if he expected to find in convertible issues that ideal combination of the safety OFA high-grade bond and price. Protection plus, the common, this may, a chance to benefit from an advance in the price of, be a good place to make a suggestion about the long-term bond of the future. Why should not the effects of changing interest rates be divided on some practical and equitable basis between the borrower and the lender? One possibility would be to sell long-term bonds with interest payments that vary with an appropriate index of the going rate. The main results of such an arrangement would be, 1. The investor's bond would always have a principal value of about 100% if the company maintains its credit rating, but the interest received will vary, say, with the rate offered on conventional new issues. 2. The corporation would have the advantages of long-term debt being spared problems and costs of frequent renewals of refinancing, but its interest costs would change from year to year. Over the past decade, the bond investor has been confronted by an increasingly serious dilemma. Shall he choose complete stability of principal value, but with varying and usually low short-term interest rates? Or shall he choose a fixed interest income with considerable variations, usually downward it seems, in his principal value? It would be good for most investors if they could compromise between these extremes and be assured that neither their interest return nor their principal value will fall below a stated minimum over, say, a May 20th, 2024 period. This could be arranged without great difficulty in an appropriate bond contract. Au fait new form. Important note, in effect, the U.S. government has done a similar thing in its combination of the original savings bonds contracts with their extensions at higher interest rates. The suggestion we make here would cover a longer fixed investment period than the savings bonds and would introduce more flexible IT&T interest rate provisions. It is hardly worthwhile to talk about non-convertible preferred stocks since their special tax status makes the safe ones much more desirable holdings by corporations, e.g. insurance companies, than by individuals. The poorer quality ones almost always fluctuate over a wide range, percentage-wise, not too differently from common stocks. We can offer no other useful remark about them. Table 16-2 below P406. Gives some information on the price changes of lower grade non-convertible preferreds between December 1968 and December 1970. The average decline was 17% against 11.3% for the S&P Composite Index of common stocks.
Commentary
on Chapter 8. The happiness of those who want to be popular depends on others. The happiness of those who seek pleasure fluctuates with moods outside their control, but the happiness of the wise grows out of their own free acts. Marcus Aurelius. Dr. Jekyll and Mr. Market. Most of the time, the market is mostly accurate in pricing most stocks. Millions of buyers and sellers haggling over price do a remarkably good job of valuing companies on average. But sometimes the price is not right. Occasionally, it is very wrong indeed. And at such times, you need to understand Graham's image of Mr. Market probably. The most brilliant metaphor ever created for explaining how stocks can become mispriced. The manic depressive Mr. Market does not always price stocks the way an appraiser or a private buyer would value a business. Instead, when stocks are going up, he happily pays more than their objective value, and when they are going down, he is desperate to dump them for less than their true worth. Is Mr. Market still around? Is he still bipolar? You bet he is. On March 17, 2000, the stock of Inktomi Corp. hit a new high of $231.625 since they first came on the market in June 1998. Shares. In the internet searching software company had gained roughly 1,900%. Just in the few weeks since December 1999, the stock had nearly tripled. The stock so valuable? The answer seems obvious. Phenomenally fast. What's going on at Inktomi, the business that could? Make Inktomi 10 Proth. In the 3 months ending, in December 1999, Inktomi sold $36 million in products and services, more than it had in the entire year ending in December 1998. If Inktomi could sustain its growth rate of the previous 12 months for just 5 more years, its revenues would explode from $36 million a quarter to $5 billion a month. With such growth in sight, the faster the stock went up, the farther up it seems certain to go. But in his wild love affair with Inktomi stock, Mr. Market was overlooking something about its business. The company was losing money, lots of it. It had lost $6 million in the most recent quarter, $24 million in the 12 months before that, and $24 million in the year before that. In its entire corporate lifetime, Inktomi had never made a dime in profits. Yet on March 17, 2000, Mr. Market valued this tiny business at a total of $25 billion. Yes, that's billion with a B. And then Mr. Market went into a sudden nightmarish depression on September 30th, 2002, just 2.5 years after hitting $231.625 per share. Inktomi's stock closed at 25 cents, collapsing from a total market value of $25 billion to less than $40 million. Had Inktomi's business dried up? Not at all. Over the previous 12 months, the company had generated $113 million in revenues. So what had changed? Only Mr. Market's mood. In early 2000s, investors were so wild about the internet that they priced Inktomi's shares at 250 times the company's revenues. Now, however, they would pay only 0.35 times its revenues. Mr. Market had morphed from Dr. Jekyll to Mr. Hyde and was ferociously trashing every stock that had made a fool out of him. But Mr. Market was no more justified in his midnight rage than he had been in his manic euphoria. On December 23, 2002, Yahoo Inc. announced that it would buy Inktomi for $1.65 per share. That was nearly 7 times Inktomi's stock price on September 30. History probably showed that Yahoo got a bargain. When Mr. Market makes stock so cheap, it's no wonder that entire companies get bought right out from under him. Will, think for yourself. You willingly allow a certifiable lunatic to come by at least 5 times a week to tell you that you should feel exactly the way he feels? Would you ever agree to be euphoric just because he is, or miserable just because he thinks you should be? Of course not. You'd insist on your right to take control of your own emotional life based on your experiences and your beliefs. But when it comes to their financial lives, millions of people let Mr. Market tell them how to feel and what to do, despite the obvious fact that, from time to time, he can get nuttier than a fruitcake. In 1999, when Mr. Market was squealing with delight, American employees directed an average of 8.6% of their paychecks into their 401k retirement plans. By 2002, after Mr. Market had spent 3 years stuffing stocks into black garbage bags, the average contribution rate had dropped by nearly 1/4 to just 7%. The cheaper stocks got, the less eager people became to buy them because they were imitating Mr. Market instead of thinking for themselves. The intelligent investor shouldn't ignore Mr. Market entirely. Instead, you should do business with him, but only to the extent that it serves your interests. Mr. Market's job is to provide you with prices. Your job is to decide whether it is to your advantage to act on them. You do not have to trade with him just because he constantly begged you to. By refusing to let Mr. Market be your master, you transform him into your servant. After all, even when he seems to be destroying values, he's creating them elsewhere. In 1999, the Wilshire 5000 Index, the broadest measure of U.S. stock performance, gained 23.8%, powered by technology and telecommunications stocks. But 3,743 out of the 7,234 stocks in the Wilshire Index went down in value, even as the rising, while those high-tech and telecom stocks were. Average was hotter than the hood of a race car on an August afternoon. Thousands of old economy shares were frozen in the mud, getting cheaper and cheaper. The stock of CMGI, an incubator or holding company for internet startup firms, went up an astonishing 939.9% in 1999. Meanwhile, Berkshire Hathaway, the holding company through which Graham's greatest disciple, Warren Buffett, owns such old economy stalwarts as Coca-Cola, Gillette, and the Washington Post company, dropped by 24.9%. But then, as it so often does, the market had a sudden mood swing. Figure 8-1 offers a sampling of how the stinkers of 1999 became the stars of 2000s through 2002. As for those two holding companies, CMGI went on to lose 96% in 2000s, another 70.9% in 2001, and still 39.8% more in 2002, a cumulative loss of 99.3%. Berkshire Hathaway went up 26.6% in 2000s and 6.5% in 2001, then had a slight 3.8% loss in 2002, a cumulative gain of 30%. Can you beat the pros at their own game? One of Graham's most powerful insights is this: the investor who permits himself to be stampeded or unduly worried by unjustified cataclysm his holdings is perversely transforming his basic advantage into a basic disadvantage. What does Graham mean by those words, basic advantage? He means that the intelligent individual investor has the full freedom to choose whether or not to follow Mr. Market. You have the luxury of being able to think for yourself. 218, the typical money manager, however, has no choice but to mimic him. Market's every move, buying high, selling low, marching almost mindlessly in his erratic footsteps. Here are some of the handicaps mutual fund managers and other professional investors are saddled with. With billions of dollars under management, they must gravitate toward the biggest stocks, the only ones they can buy in the multi-million-dollar quantities they need to fill their portfolios. Thus, many funds end up owning the same few overpriced giants. Investors tend to pour more money into funds as the market rises. The managers use that new cash to buy more of the stocks they already own, driving prices to even more dangerous heights. If fund investors ask for their money back when the market drops, the managers may need to sell stocks to cash them out. Just as the funds are forced to buy stocks at inflated prices in a rising market, they become forced sellers as stocks get cheap again. Many portfolio managers get bonuses for beating the market, so they obsessively measure their returns against benchmarks like the S&P 500 index. If a company gets added to an index, hundreds of funds compulsively buy it. If they don't, and that stock then does well, the managers look foolish. On the other hand, if they buy it and it does poorly, no one will blame them. Increasingly, fund managers are expected to specialize. Just as in medicine, the general practitioner has given way to the pediatric allergist and the geriatric otolaryngologist. Fund managers must buy only small growth stocks or only mid-size value stocks, or nothing but large blend stocks. If a company gets too big or too small or too cheap or an itty bit too expensive, the fund has to sell it even if the manager loves the stock. So there's no reason you can't do as well as the pros. What you cannot do, despite all the pundits who say you can, is to beat the pros at their own game. The pros can't even win their own game. Why should you want to play it at all? If you follow their rules, you lose, since you will end up as much a slave to Mr. Market as the professionals are. Chapter. Instead, recognize that investing intelligently is about controlling the controllable. You can't control whether the stocks or funds you buy will outperform the market today, next week, this month, or this year. In the short run, your returns will always be hostage to Mr. Market and his whims, but you can control your brokerage costs by trading rarely, patiently, and cheaply, your ownership costs by refusing to buy mutual funds with excessive annual expenses, your expectations by using realism, not fantasy, to forecast your returns, your risk by deciding how much of your total assets to put at hazard in the stock market, by diversifying, and by rebalancing. Your tax bills by holding stocks for at least 1 year and, whenever possible, for at least 5 years to lower your capital gains liability. And most of all, your own behavior. If you listen to financial TV or read most market columnists, you'd think that investing is some kind of sport or a war or a struggle for survival in a hostile wilderness. But investing isn't about beating others at their game. It's about controlling yourself at your own game. The challenge for the intelligent investor is not to find the stocks that will go up the most and down the least, but rather to prevent yourself from being your own worst enemy, from buying high just because Mr. Market says buy, and from selling low just because Mr. Market says sell. If your investment horizon is long, at least 25 or 30 years, there is only one sensible approach. Buy every month, automatically, and whenever else you can spare some money. The single best choice for this lifelong holding is a total stock market index fund. Sell only when you need the cash. For a psychological boost, clip out and sign your investment owner's contract, which you can find on P2BN. Financial, 225. Intelligent investor, you must also refuse to judge your success by how a bunch of total strangers are doing. You're not one penny poorer if someone in Dubuque or Dallas or Denver. 220 commentary on Chapturo. Beats the S&P 500 and you don't. No one's gravestone reads he. Beat the market. I once interviewed a group of retirees in Boca Raton, one of Florida's wealthiest retirement communities. I asked these people, mostly in their 70s, if they had beaten the market over their investing lifetimes. Some said yes, some said no. Most weren't sure. Then one man said, "Who cares? All I know is my investments earned enough for me to end up in Boca." Could there be a more perfect answer? After all, the whole point of investing is not to earn more money than average, but to earn enough money to meet your own needs. The best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. In the end, what matters isn't crossing the finish line before anybody else, but just making sure that you do cross it. Your money and your brain. Why then do investors find Mr. Market so seductive? It turns out that our brains are hardwired to get us into investing trouble. Humans are pattern-seeking animals. Psychologists have shown that if you present people with a random sequence and tell them that it's unpredictable, they will nevertheless insist on trying to guess what's coming next. Likewise, we know that the next roll of the dice will be a 7, that a baseball player is due for a base hit, that the next winning num. Beer in the Powerball lottery will definitely be for minus 27, minus 9, minus 16, minus 40 to minus 10, and that this hot little stock is the next Microsoft. Groundbreaking new research in neuroscience shows that our brains are designed to perceive trends even where they might not exist. After an event occurs just 2 or 3 times in a row, regions of the human brain called the anterior cingulate and nucleus accumbens automatically anticipate that it will happen again. If it does repeat, a natural chemical called dopamine is released, flooding your brain with a soft euphoria. Thus, if a stock goes up a few times in a row, you reflexively expect it to keep going, and your brain chemistry changes. As the stock rises, giving you a natural high, you effectively become addicted to your own predictions. But when stocks drop, that financial loss fires up your amygdala-Partoth brain that processes fear and anxiety and generates the famous fight or flight response that is common to all cornered ani. Mals. Just as you can't keep your heart rate from rising if a fire alarm goes off, just as you can't avoid flinching if a rattlesnake slithers onto your hiking path, you can't help feeling fearful when stock prices are plunging. In fact, the brilliant psychologists Daniel Kahneman and Amos Tversky have shown that the pain of financial loss is more than twice as intense as the pleasure of an equivalent gain. Making $1,000 on a stock feels great, but a $1,000 loss wields an emotional wallop more than twice as powerful. Losing money is so painful that many people, terrified at the prospect of any further loss, sell out near the bottom or refuse to buy more. That helps explain why we fixate on the raw magnitude of a market decline and forget to put the loss in proportion. So, if a TV reporter hollers, "The market is plunging, the Dow is down 100 points," most people instinctively shudder. But at the Dow's recent level of 8,000, that's a drop of just 1.2%. Now think how ridiculous it would sound if, on a day when it's 81 degrees outside, the TV weatherman shrieked, "The temperature is plunging, it's dropped from 81 degrees to 80 degrees. That, too, is a 1.2% drop. When you forget to view changing market prices in percentage terms, it's all too easy to panic over minor vibrations. If you have decades of investing ahead of you, there's a better way to visualize the financial news broadcasts. See the sidebar on P222. In the late 1990s, many people came to feel that they were in the dark unless they checked the prices of their stocks several times a day. But, as Graham puts it, the typical investor would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other person's mistakes of judge. News you could use. Stocks are crashing, so you turn on the television to catch the latest market news. But instead of CNBC or CNN, imagine it. You can tune in to the Benjamin Graham Financial Network. On BGFN, the audio doesn't capture that famous sour clang off the market's closing bell. The video doesn't home in on brokers scurrying across the floor of the stock exchange like angry rodents. Nor does BGFN run any footage of investors gasping on frozen sidewalks as red arrows whiz overhead on electronic stock tickers. Instead, the image that fills your TV screen is the facade of the New York Stock Exchange, festooned with a huge banner reading, "Sale 50% off." As intro music, Bachman Turner Overdrive can be heard blaring a few bars of their old barn burner, "You ain't seen nothing yet." Then the anchorman announces brightly, "Stocks became more attractive yet again today," as the Dow dropped another 2.5% on heavy volume the fourth day in a row that stocks have gotten cheaper. Tech investors fared even better, as leading companies like Microsoft lost nearly 5% on the day, making them even more affordable. That comes on top of the good news of the past year, in which stocks have already lost 50%, putting them at bargain levels not seen in years. And some prominent analysts are optimistic that prices may drop still further in the weeks and months to come. The newscast cuts over to market strategist Ignaz Anderson of the Wall Street firm of Ketchum Amp Skinner, who says, "My forecast is for stocks to lose another 15% by June. I'm cautiously optimistic that if everything goes well, stocks could lose 25%, maybe more." "Let's hope Ignaz Anderson is right," the anchor says cheerily. Falling stock prices would be fabulous news for any investor with a very long horizon. And now over to Wally Wood for our exclusive AccuWeather forecast. Meant. If, after checking the value of your stock portfolio at 1:24 p.m., you feel compelled to check it all over again at 1:37 p.m., ask yourself these questions. Did I call a real estate agent to check the market price of my house at 1:24 p.m.? Did I call back at 1:37 p.m.? If I had, would the price have changed? If it did, would I have rushed to sell my house by not checking or even knowing the market price of my house from minute to minute? Do I prevent its value from rising over time? 10. The only possible answer to these questions is of course not, and you should view your portfolio the same way. Over a 10 or 20 or 30-year investment horizon, Mr. Market's daily dipsy doodles simply do not matter. In any case, for anyone who will be investing for years to come, falling stock prices are good news, not bad, since they enable you to buy more for less money. The longer and further stocks fall, and the more steadily you keep buying as they drop, the more money you will make in the end if you remain steadfast until the end. Instead of fearing a bear market, you should embrace it. The intelligent investor should be perfectly comfortable owning a stock or mutual fund, even if the stock market stops applying daily prices for the next 10 years. Paradoxically, you will be much more in control, explains neuroscientist Antonio Damasio. If you realize how much you are not in control by acknowledging your biological tendency to buy high and sell low, you can admit the need to dollar cost average, rebalance, and sign an investment contract by putting much of your portfolio on permanent autopilot. You can fight the prediction addiction, focus on your long-term financial goals, and tune out Mr. Market's mood swings. When Mr. Market gives you lemons, make lemonade. Although Graham teaches that you should buy when Mr. Market is yelling, sell, there's one exception the intelligent investor needs to understand. Selling to a bear market can make sense if it creates a tax windfall. The U.S. Internal Revenue Code allows you to use your realized losses, any declines in value that you lock in by selling your shares, to offset up to $3. 0000 in ordinary income, .12. Let's say you bought 200 shares of Coca-Cola stock in January 2000s for $60 a share, a total investment of $12,000. By year to end 2002, the stock was down to $44 a share, or $8,800 for your lot, a loss of $3,200. You could have done what most people do, either whine about your loss or sweep it under the rug and pretend it never happened, or you could have taken control. Before 2002 ended, you could have sold all your Coke shares, locking in the $3,200 loss. Then, after waiting 31 days to comply with IRS rules, you would buy 200 shares of Coke all over again. The result, you would be able to reduce your taxable income by $3,000 in 2002, and you could use the remaining $200 loss to offset your income in 2003. And better yet, you would still own a company whose future you believe in, but now you would own it for almost 1/3 less than you paid the first time, and lock in a loss. If Uncle Sam wants to make Mr. Market look logical, with Uncle Sam subsidizing your losses, it can make sense to sell. By comparison, who are we to complain? Hereby state that I am an investor who is seeking to accumulate wealth for many years into the future. You know that there will be many times when I will be tempted to invest in stocks or bonds because they have gone or are going up in price, and other times when I will be tempted to sell my investments because they have gone or going down. I hereby declare my refusal to let a herd of strangers make my financial decisions for me. I further make a solemn commitment never to invest because the stock market has gone up, and never to sell because it has data 00 per month. Every month, gone down. Instead, I will invest through an automatic investment plan or dollar cost averaging program into a following mutual fund as for diversified portfolios. I will also invest additional amounts whenever I can afford to spare the cash and can afford to lose it in the short run. 20, the only. I hereby declare that I will hold each of these investments continually through at least the following date, which must be a minimum of 10 years after the date of this contact. Exceptions allowed under the terms of this contract are a sudden, pressing need for cash, like a healthcare emergency or the loss of my job, or a planned expenditure like a housing down payment or a tuition bill of this contract, but to reread this document whenever I am tempted to sell. I am, by signing below, stating my intention not only to abide by terms, any of my investments, be kept in a safe place that is easily accessible for future reference.